Hello, everyone. Welcome back to Gold Off the Charts. In this complex financial market full of hidden agendas and noise, we don't just look at the surface-level hype, we look for the real mechanics underneath. A little deep financial thinking every day will help you see further, trade steadier, and survive longer than the crowd on your path to building wealth. In today's video, I'm asking everyone to take 3 deep breaths to calm down. Why? Because we are witnessing a historic moment that will be recorded in the textbooks of human finance. If you feel like the market moves over the past month have blown your mind, let me tell you. What happened last night is practically insulting the intelligence of every economist out there. Looking at the charts from the past 2 days, gold isn't just rising, it's going parabolic and looks unstoppable. Spot gold just hit a staggering high of $5,602 per troy ounce. Remember that number, folks. Since the beginning of this year, in less than 2 months, the price of gold has surged by 30%! A move this steep and powerful is incredibly rare in the thousands of years of gold's history. What happened? Why did the market suddenly catch fire over the last 2 days? Why is even the Fed's interest rate decision usually the most feared event for traders, being treated like a scrap of paper by gold? Right now, everyone is asking 2 things. First, where is the ceiling for a market that's burning out of control? Second, with gold at 5,600, is it still a buy or is it too late? Today, Wang Jin is going to help you navigate these messy charts to crack the code behind this surge. We're talking about the gamma squeeze that caused market makers to melt down. We'll look at the latest warning from the creator of the dollar smile theory, and we must also break down the chilling article by Ray Dalio, the founder of Bridgewater Associates. He believes we are on the brink of a collapse of the current world order. By the end of this video, you'll realize the scale of this game is far bigger than you imagined. With gold rushing toward $5,600, this could be a once-in-a-lifetime turning point for ordinary people. I'll show you how to read the hidden hand of big capital. Here is how to find a lifeline in the middle of the madness. Okay, enough talk. Let's get started. First, we have to address the question everyone is asking. What happened yesterday to cause gold to have a violent rally that completely ignored fundamentals in such a short time? To explain this, we need a professional term. There is a somewhat aggressive term called a gamma squeeze. Sounds complicated, right? Don't worry, I'll explain it in plain English. You need to know how serious this is. In the financial markets, market makers, the big banks, and institutions provide the liquidity that lets us trade. When a massive wave of retail investors and hedge funds start frantically buying call options, market makers are actually the ones taking the opposite side of the trade. Right after gold broke 5,300 on January 28th, it triggered a chain reaction in the options market. Because at the strike prices of 5,550 and 5,600, there was a massive backlog of call options. When gold actually hit those prices, the market makers who sold those options went into a total panic. Why? Because if the price of gold keeps rising, their potential losses are theoretically infinite. To protect themselves and hedge their risk, market makers are forced into the futures market. They start panic buying gold futures to cover their positions. This creates a terrifying death spiral. The higher gold goes, the more market makers must buy to hedge. The more they buy, the faster the price rises, which triggers more options at higher prices, forcing even more buying. This force can completely take over the market in a heartbeat, drowning out geopolitics and economic logic to create a violent move driven purely by the money game. That's why you saw that irrational, vertical move in gold prices last night. Meanwhile, the Fed's interest rate decision, usually a global bombshell, ended up being nothing more than a background detail. To be honest, the meeting lacked any real news, and the market's reaction was quiet. The Fed kept rates unchanged, as expected. Powell's speech was more of the same. The economy is strong, and we're in no rush to cut rates. Normally, this hawkish tone not cutting rates should make the dollar go up and gold crash. But what happened? The dollar ticked up for a few minutes before being totally crushed by gold's massive rally. This sends a very important signal. The market is no longer listening to the Fed. It's not interest rates driving gold right now, it's the fear of a systemic collapse. Next, let's explore a deeper, more unsettling reason. Have you ever heard of the dollar smile theory? Its creator, Stephen Jen, the godfather of the Forex market, recently issued a warning that could cause an earthquake in the currency world. He pointed out that a whole generation of analysts has fallen into a trap of autopilot thinking. They assume a strong dollar and a strong U.S. economy always go together. They subconsciously believe that as long as the U.S. economy is doing better than everyone else, the dollar will rise. But Stephen Jen says, these people have no idea how to handle the new reality. The dollar is weakening even while the U.S. economy stays strong. That sounds like a contradiction, doesn't it? But this is exactly what is happening right now. Something very interesting happened on Tuesday. President Trump told reporters in Iowa he wasn't worried about the dollar losing value. He even publicly stated that the recent dollar decline is good for U.S. companies. As soon as he said that, the dollar had its biggest one-day drop since the tariff wars began last year. The Bloomberg Dollar Index fell straight to its lowest level in nearly 4 years. Why are the president's words so powerful? Because the market is questioning the trust factor in the U.S. Anthony Doyle, a top strategist at Pinnacle Investment Management, put it sharply. When the very people who should be supporting the dollar seem totally indifferent to its fall, investors feel like the floor is disappearing, people are starting to ask a soul-searching question. Is the U.S. asking investors to accept a lower standard of stability? If so, investors are going to demand a much higher risk premium. Look at the data. JP Morgan's index shows that risk reversal indicators for the dollar against major currencies have hit their lowest point since last June. This means big money globally is frantically buying insurance in the options market to hedge against a long-term dollar crash. Even more shocking data comes from the OECD. Based on purchasing power parity, the US dollar is actually dangerously overvalued against almost every major currency except the Swiss franc. The yen and euro especially are dirt cheap. When Trump welcomes a weaker dollar and US debt is about to hit $40 trillion, global investors get a retreat signal. Stephen Jen warned that this is likely just the start of a massive dollar slide that many people are totally unprepared for. When everyone starts quietly exiting U.S. assets, the only place left to go is gold. If Stephen Jen is giving us a warning from a currency perspective, then Ray Dalio, the billionaire founder of Bridgewater, is showing us a chilling truth through the lens of historical cycles. On January 27th, Dalio published a long-form article titled Currency, Civil War, and International War. In this piece, he stopped being subtle and directly declared the U.S. is on the edge of a systemic collapse. In Dalio's view of history, the life cycle of an empire has 6 stages. Stage 5 is failing finances, a massive wealth gap, and extreme political polarization. Stage 6 is the darkest, civil war and revolution. Dalio believes we are currently at the tipping point between Stage 5 and Stage 6. Why does he say that? He's tracking a leading indicator of societal breakdown, the recent violent unrest in Minneapolis. As a macro investor who looks past the noise, Dalio searches for cycle markers. He believes that when social disagreements can no longer be settled by laws, institutions, or voting, and when armed conflict breaks out in the streets, it means we are entering the violent phase of a civil war. This is the result of a toxic cocktail. First, a debt explosion. Second, a massive gap in wealth and values. And third, severe economic shocks. In this environment, Dalio says, the media goes crazy, rules are ignored, and a primitive battle begins. What does this mean? It means the foundation of law and contracts that keeps the market running is shaking. The wealthiest cities in the U.S., like New York, Chicago, and San Francisco, are also the ones with the most debt and the biggest wealth gaps. These places are powder kegs waiting for a spark. Dalio's most practical and frightening advice for investors is, when in doubt, get out. He specifically warned about capital controls. History shows that when a country falls into chaos, the government will stop money from leaving. You want to withdraw? The door is closed. You want to transfer money abroad? Sorry, frozen. So, when investors of Dalio's caliber start talking about leaving, what does smart money do? They look for an asset that doesn't require a government's promise, something that works everywhere and can't be deleted by a politician. That's why money is pouring into gold. This isn't just price speculation, this is buying survival insurance. But we can't talk about gold. without talking about its more volatile and wild little brother silver. If you think gold's 30% rise is crazy, silver is reaching a whole new level of madness. On January 27th, Citibank released a very bold report. They hiked their 3-month price target for silver from $100 straight to $150 per ounce in one go. Citi stated bluntly, silver is no longer just following gold, it's acting like gold on steroids. Why is Citi so bullish? First, the logic behind silver's price has fundamentally changed. We used to look at silver based on industrial demand for solar panels and EVs. But Citi believes silver has moved beyond its industrial roots and is now copying gold's safe haven logic. Global funds see it as the ultimate tool for hedging against macro chaos and geopolitical risks. Citi describes silver not as gold's shadow, but as the exponential version of gold. When gold moves up 10%, silver often jumps 30%. This high beta makes it the top choice for aggressive capital. Second, the engine of this bull market is in the East. Citi pointed out that China is the dominant force behind this silver rally, and India is buying as much as they can. We see data that the premium for silver in Shanghai compared to London is at an all-time high. This proves that Chinese demand is incredibly strong. The most unusual thing is India. Historically, Indian buyers are very smart. They buy low and sell high. However, silver premiums in India are now rising along with the price. This shows that even disciplined Indian investors have started chasing the rally. When China and India both start panic buying, it's proof that silver is in a supercycle. Third, government intervention is failing. Even though China tried cooling the market by suspending silver ETFs and raising margin requirements, Citi believes this won't stop the trend. Investor psychology has shifted. People aren't looking for fair value anymore, they are trend following. In this momentum-driven market, as long as silver doesn't look ridiculously expensive relative to gold, funds will keep buying. The most shocking part? Silver is surging despite every traditional bearish signal. Inventories are dropping, ETFs are seeing outflows, and hedge funds are taking profits. Normally, these signals would crash the price. But in today's era of macro risk, the old supply and demand models have failed. How high can silver go? Citi used a gold to silver ratio to measure it. If gold stays between $5,100 and $5,400 and the ratio hits its 2011 low of about 31 to 1, the price would be 170. If we see an extreme scenario like 1971, a 14 to 1 ratio, the price could point toward $300. While 14 to 1 is unlikely, it shows that compared to gold, silver still has a massive amount of room to run. After looking at all this wild data and macro logic, I want to talk to you heart to heart. Since the start of the year, gold and silver have blown everyone's expectations away. Whether you're a Wall Street pro or a beginner trader, we are all being swept up by this historic tide. But in a market like this one, we might only see every 20 years. There is one thing I must remind you. Don't rely on your gut to guess the top. Why? Because with a trend this historic, old logic doesn't apply. You might misjudge the global situation and underestimate how far the world's elite will go to save their wealth. You might also underestimate how much the U.S. government wants a higher gold price to help devalue and manage that $40 trillion debt. Any attempt to predict the top and go short right now could result in you being steamrolled by the market. However, I also want to remind you that despite the gains, you must stay level-headed. Technically, gold has seen an extremely rare 9 consecutive green days. In any normal market, that's a signal that things are overbought. This means a pullback could happen at any moment, and when it does, it could be sharp and scary. What should you do when the volatility hits? My advice: stay calm, don't panic, and don't get shaken out of your position too easily. If you're a long-term investor, you're looking at what Dalio calls the reshaping of order. You're watching the collapse of dollar credibility that Steve and Jen talked about. As long as those core reasons haven't changed, a short-term drop is just a second chance for people who missed the bus to get in. The current market is like a charging bull. It can take you to the peak of wealth, but it can also be a very bumpy ride. At this turning point in history, we need the courage to buy, the discipline to hold, and a healthy respect for risk. Not guessing the top doesn't mean ignoring your position size. Staying sober while others are drunk is the only way to win in the long run. Finally, a quick reminder, all the analysis above is based on my personal observations of market data, news, and logic. My goal is to help you clear your head and see the truth through the fog. This is not direct investment advice. The market is risky, and trading requires caution. Everyone's risk tolerance is different, so please make your own decisions based on your own style. Investing is a journey, and other people's views are just references. Your own judgment is the key. That's all for today. If you found these insights helpful, or if they helped you make sense of this crazy market, please leave a comment and let me know what you think. Don't forget to like and subscribe to Gold Off the Charts and share this with your friends. This is Gold Off the Charts. I'm here to walk with you through this wild and opportunistic era. I'll see you in the next video.